everyone, a very good morning. You're watching Buy Now, Sell Now on ET Now this Friday morning. I'm Ubina Kapasi, and today on the show I also have with me my co-anchor Varun Hirimat. Hi Varun, let's tell you what exactly is up with the market as we speak, and the recovery rally, if you could call it that, does continue as the Nifty has managed to reclaim the 11,400 mark. And this pace continues from the what we saw yesterday, but mind you, the gains are fairly limited. We are just sitting at about 0.25% of gains today in trade, so fairly limited, but nevertheless we are in the green with small gains.
Right, Mubina, and the markets sound just as upbeat as you do. Let's remember yesterday the Nifty clawed up above 1%, although a lot of your Nifty stocks didn't really perform. And that's because Reliance was doing the heavy lifting yesterday. And even today, I feel like it's very upbeat. It's firmly holding above 2,300. There's been basically no retrenchment on that counter whatsoever. The chart remains strong, and that's definitely pulling its weight on the Nifty today as well, keeping our markets pretty stable after a very weak global handover. Okay. And then moving forward, we also have a major block deal we'd like to bring to your attention. Max Healthcare has rallied 5.2% right now after equity, it's rallying after 5.2% of equity has traded in a block deal. Amber Enterprises has slid after 10.5% equity trades in a block deal. So two different reactions, but large blocks being traded out on the exchange early this morning. Next, we have the moratorium debate that needs to be brought to light today. The government has appointed an expert panel to access relief to borrowers. So yesterday's or day before Supreme Court hearing, basically there was a deferment of 2 weeks, and now we're seeing some measures following. Seems a panel will be figuring out exactly how relief is to be allotted. Then moving forward, we also have an IPO watch for you from an already existing company, InfoEdge, which partly owns Zomato. Zomato plans an IPO in H1 of next year, so it looks like that might be getting a listing of its own. And we all know that Zomato, Swiggy, all these platforms have been seeing tremendous traction during COVID, so it'll be interesting to see what kind of A, valuation it gets, and then B, the response it gets. Finally, as far as headlines are concerned, something that's not too positive, but we still need to talk about it, is the India-China border tension. There is, however, at least a positive development that's coming out of this whole conflict we're having, whereas we've managed to agree with China on a 5-point plan to resolve the border standoff in eastern Ladakh, and we'll be bringing you more on the finer points of that particular arrangement in just a bit.
Okay, well, let's take a look at what the markets are up to, and like we flagged off, we're just seeing about 0.2% of gains, 11,460 for the Nifty. Sensex is actually absolutely flat with just a little bit of green seen on the screen. Realty and IT, these two are really standing out in today's trading session. Well, I mean, Realty, for one, does not really have any bearing or weightage on the indices, so frankly, it doesn't really matter from an index point of view. But IT, look at that one. Wipro Limited is higher by 3%. Tech Mahindra is higher by 1.7%. Bharti Infratel as well is snapping that losing streak, and today it's gaining approximately 2.8%. Some names from the consumption space as well, and Titan and Britannia Industries are what's standing out. But mind you, the gains over here as well fairly limited. On the losing side, we do have the utility names. So Power Grid and IOC are something that stand out. Asian Paint seems to be bucking the trend over there, 1% gone. Banking continues to be a weak spot. The Nifty Bank is down by roughly about 0.25%. IndusInd Bank today is something that's catching my attention. From the broader markets, or rather from the small cap names, it's Amber Enterprises down 5.7%. India down 3%, KNR Constructions, PVR as well losing in trade. But we do have a couple of gainers. Hindustan Copper, one unlikely gainer is also PC Jewelers. We haven't spoken about that one in a while. NIIT Tech, again from the technology pack. So, you're seeing some momentum over there. And Strides Pharma, that's gaining 5.8%. Let's welcome on the show our regular Kunal Bothra to join us on the technicals. We also have today Shahina Mukaddam on the fundamentals. Good morning to both of you. Kunal, as always, let's start off with you first. First, your take on the equity markets. Anything that's catching your attention in the way we've moved in this week gone by? It's not been the best of weeks, that's for sure. And also, if you could share with us your high risk and low risk ideas.
So, good morning, Mubina. First of all, I think yes, not a great week for the markets. Too much of volatility, and I think the markets are not being accustomed to these kind of volatile times. At least the last 4-5 months, where there has been so much of stability, so much of positivity for the market. So this comes as a bit of a difficult week or a tough week for the markets. But then I think there are a lot of positives to take away for the markets this week as well. One is that right from the start of this week, from Monday itself, you had the Nifty IT index, which managed to move up higher and show some signs of strength and resilience. Now we can one can debate and one can argue that whether this was a move towards parking the money on the defensive sides or whether there's a fresh sectoral trend which is happening. So I think in that regards, many of these IT stocks, they still look very strong today. You're seeing a continuation move in many of the IT pack. So the comeback rather of Reliance Industries, I think which
okay,
was
thanks for that, Kunal. And what about your high risk, low risk idea for today?
So I think in terms of picks, I would suggest two calls. The first one would be a buy on IndusInd Bank. I term this more as a high risk trade because I'm expecting Bank Nifty to move up higher from current levels. So IndusInd Bank is a buy. Short-term targets to be kept at 650, stop loss at 590. And the second would be a slightly low risk idea, and it would be a buy on a mid-cap IT name, NIIT Limited, stock trading at 126, 127 range. Would suggest a buy with a target of 144 and stop loss 118.
Okay, it seems that Shahina is having some trouble connecting right now. So let's get on with our queries. And Kunal, it's going to be just technicals for a little while. We have Rakesh Yadav from Mumbai who's written to us. He bought 100 shares of Bajaj Finance at 3,200. And he wants to know things from a near-term outlook. So how's that near-term chart looking, Kunal?
It's a good stock where you can continue to hold. There was this, I would say, correction on Bajaj Finance from 3,700 to 3,300, 3,400 zone, but that seems to now getting over. Now, today's price move for Bajaj Finance, even if it's up 1% odd, but I still believe it gives you a lot of confidence because this move has led a turn on the many of the indicators. So in this fall, which I'm talking about from 3,700 levels for Bajaj Finance, many of the indicators had gotten back into an oversold territory, and then you naturally see a bounce from those levels. There is a bit of a fight in terms of bulls and bears at those oversold marks. So I would sense that this 3,400 mark, plus or minus say 100 odd points for Bajaj Finance, could probably act as a pivot range or a pivot support. Now, since you bought at 3,200 levels, I think you already have a good cushion in terms of holding the stock. So I think if you're not in a hurry and you can hold for say another 3 to 4 weeks, then I would place in an upside target of 3,700 on Bajaj Finance. And for that, if you wish, then you can have a trailing stop loss which could be kept at 3,300 to 3,350 zone.
Okay, so if you have an outlook or if you have a time horizon of 3 to 4 weeks, then levels of 3,700 are possible according to Kunal on a Bajaj Finance. Let's take on board our next query. Joginder Thakur from Mumbai writes in to us saying that he has purchased Lemon Tree and EIH in April. And obviously since April, literally almost every stock has rallied to date, Lemon Tree and EIH included, even though of course these have borne the brunt of the lockdown with the recreationals and the travel related stocks really being the most hit because of the lockdown. But nevertheless, recovery has been witnessed. Disruption in earnings, but outlook is absolutely positive. So Kunal, book out at these levels. He clearly has bought this keeping in mind a short-term trade itself, and I guess it's worked for him. So do you think he should book out or perhaps a few more weeks?
I think you can continue to hold on for some more time. I believe even though stocks like Lemon Tree, etc., they're not they're not as trending stocks as one would probably expect for a mid-cap name. But nevertheless, these stocks, they tend to move when the markets get into the favoritism for the hotel names, etc. So we saw Indian hotels moving up higher. I think mid of August or start of August, where you saw Indian hotels moving up higher, and that had a cascading effect into many of these other such similar names or peers as well. And you saw Lemon Tree moving up from I think 20 levels to almost a 30-35 kind of a zone in a very short span of time. So the stocks are showing signs of life again. The immediate peer, that's Indian hotels, I think looks of course far more stable and attractive. But purely on the charts, I believe stocks like Lemon Tree also you can hold on. If you've bought in the March April lows, then I believe you are already sitting in the money in decent profits into your holdings into both of these names, EIH as well as Lemon Tree. And looking at the trends, there could be a case that these stocks can just about build up gains higher and higher from current levels. So I think in that regards, there is a possibility that if you're not in a hurry, if it's not a short-term view, you can continue to hold both these stocks.
Okay, thanks for that, Kunal. Our third query is a bit generic. We have Archit Pathak writing to us from Bombay, and he's saying, please give us some good IT picks. So, according to you, within large cap, small cap, mid cap, where are you finding something exciting, Kunal?
The stocks which I've been talking about, quite vocally about, from the IT pack is Wipro. Now, yes, on one hand, the other large cap names, and when you talk about the large cap IT stocks, it's just the two names which generally strike anyone's mind, and that's the likes of Infosys and TCS. Of course, both these stocks they look quite solid and strong. But then, what transpired with Wipro in the last 5-6 months of the price recovery has not been seen, in the stock since last so many years. There was a change of behavior, change of characteristics. The volumes shot up higher. There was a strong, demand surge which happened to the stock. There was a phase in the month of June, July, where the delivery volumes for Wipro had shot up significantly higher, and from there on, the stock has just about moved up and up, from those June high, June, July kind of parameters. So I think it indicates that the stock is starting a new trend for itself. When you see those typical change of behavior and those change of characteristics, and I'm talking of the long-term characteristics, it generally denotes that there is a long-term reversal which is likely to happen. So I think out of the IT pack, of course, IT stocks overall look very attractive to me. But out of the IT pack, if I have to choose single-handedly just one stock, then I believe Wipro could be that pick. The stock is at 290 approximately. Now it's moved up, I think, 2-3-4% higher today. But I believe it's not a short-term pick you should be looking at. As a multi-year play, I think an upside of, I think, around 30 to 40%. So the next 1 or 2 years could not be ruled out on a stock like Wipro.
All right. Well, there you have it. That's, of course, Kunal's word on IT. But we managed to bring on board Shahina Mukaddam as well. Hi, Shahina. I'm going to take on board this question with you. Archit Pathak's asked for recommendations on IT stocks. The defensives really have been the flavor of 2020 amidst this entire pandemic. What would you pick out from the flurry of IT stocks that are there? And there's a very clear demarcation between the large caps and, of course, the smaller guys. Where do you find, value? Where do you see potential for run up even from these levels?
I would stick with the large caps as of now. I would go with an Infosys and HCL Tech. I think both of them have shown a lot of resilience in these times. And if you see their order book also, it is picking up. I think even in terms of the stock price performance, if you see the last couple of months, the pickup has, the bounce back has not been as much as we've seen in some of the other sectors. So it is some time that the IT will catch up, and which we are seeing today actually. And I would go with Infosys and HCL Tech. I think these two are showing very good resilience.
China sticking with the large caps, Infi and HCL Tech, according to her, are something that are showing resilience and perhaps promise for potential returns as well. Shahina, I'm going to ask you, and I'm going to club together the earlier two questions as well that we got Kunal to answer, but we would love a fundamental take from you as well. One was Rakesh's question on Bajaj Finance. He actually wanted to, get in a check on the near-term outlook for the stock, but for the benefit of all our viewers, Bajaj Finance has been one of those huge huge wealth creators. Do you think from here on as well, the stock holds promise for the long term? And secondly, Lemon Tree and EIH. What do you make of these two stocks?
Starting off with Bajaj Finance, it is one of the most expensive stocks in today's market. At the same time, with a book value of about, price to book of about 5 times, and estimated EPS of FY21 of about 680, it is very expensive. So having said that, fundamentally, I think, if one is really buying the stock, you can expect very marginal sort of returns. I don't expect the stock to run away. At the same time, in the short term, I think the bounce, given the technical charts, could take the stock up to 3,800. So if one is looking at a short term, one could continue holding, because every time the stock corrects, there's a lot of fund buying and a lot of investor interest that is coming back. So the downside looks like, it's protected. Each time it corrects, it bounces back. So I would hold and then target 3,800 for the nearer term. The other two stocks in terms of the hotel industry, I think it is picking up. It's not out of the woods, and if you saw the numbers, like for EIH, Lemon Tree, I think the impact of the COVID-19, they are taking the major hit. At the same time, I believe that there is some sort of green shoot that is coming up. And for EIH, I would keep a target of about 95. I think at current levels, I would prefer EIH actually of the two. So I would keep a target of 95 and hold it at current levels.
Okay, great. Thanks for that, Shaina. So you're more upbeat on Oberoi than a Lemon Tree, understandably. As part of our high-risk, low-risk segment, what's on your radar today?
Let's start with the low risk. The low risk, I'll go with the Coromandel International. I think the monsoons have been very good this time, and the numbers of Coromandel actually reflect this sort of good monsoons and the good pickup in demand for both their products. Like they have got a good market. They are majorly into NPK and DAP, and both these segments have grown about 80% in volume. Very strong in the south. The numbers were very strong. So I think in terms of valuation, in terms of investor interest, this is one stock that is likely to continue to do well. Even one of the smaller segments that they have in terms of crop protection, which is just about 15% of their turnover, but it is also growing very strongly both in domestic as well as export market. So that would be, I would say, quite a safe stock for the medium to longer term. And high risk stock, I will go with Z. Z Entertainment, if you see the equity shareholding pattern, now the promoters don't have more than 5% also of the equity. And the pledge is also very small. So to that extent, the overhang that was there on the stock, in my view, is gone. And the actual business segments, while we have seen advertising take a big hit, and it will continue to do so, I think a 25% decline in FY21 is factored into current price. Subscription is doing reasonably well, and I think their E5 is picking up. The OTT platform should do well for them. So I see a lot of investor interest will come in, and I think this can take the stock up to 300 type of levels. So it's high risk, but I would be invested, and I personally have invested.
Okay, there's a little disclaimer from Shaina. She has invested. But on that note, thanks so much for taking out the time to you both, Kunal and Shaina. Always great to get perspective from you. It's almost time for a quick break here on BNSN, but before we do, listen in to what Mark Matthews and Julius Baer had to say about tech stocks leading the rally, and about tech stocks also seeing improved sentiment, both fundamentally and technically. Listen in.
My sense is that the fundamental picture is unchanged. What happened instead was a excessive enthusiasm toward the technology sector in general, driven by these online brokerages that are offering zero commission trading. And so Ameritrade, Robinhood, that kind of thing. And we can see, particularly in the options market, there's been a real spike in call options. In other words, bullish contracts. And these will be expiring next Thursday. And so I still think we can get quite a bit of chop in the U.S. market as these retail investors who don't want to actually pony up the capital to hold the underlying share get out of these options. But going back to the fundamentals, they are intact. And the liquidity is intact that's being provided by the central banks. So what we're getting is a shakeout from retail, and that can often be quite brutal. But we would want to stay the course in the market because, as I said, it hasn't changed. And you know, I also want to say there's a distinction between the technology sector and everything else, as we all know. So, yes, there's been a large pullback in the NASDAQ, in excess of 10% from last Wednesday's peak. But there hasn't been nearly as much of a pullback in the rest of the world. It's only sort of down around 1%. The entire MSCI world, excluding United States index, is down about 1 or 2%.
Okay, hi, welcome back to Buy Now, Sell Now. As we've been doing every day, we have the BNSN quiz for you today. So do take a look at our Twitter handle, Buy Now, Sell Now, where we have posted the question, but I'll just read it out for you. It's which company has had the highest CAGR over the last 5 years for sales growth? So your options are logistics companies today. So we have 4 options for you, which you can see: Aegis, All Cargo, VRL, and Mahindra Logistics. Do tweet your answer, and if you get it correct, at just about 12 o'clock, we'll announce the winners, and you'll see your Twitter handle flash on the screen. So do have a look if you are interested. But coming back to markets and what's important and relevant, earlier in the day, we spoke to T.T. Srinivasaraghavan of Sundaram Finance, who mentions that the industry's priority should not rest on chasing gains for FY21. He also expects the industry to witness some delinquencies in Q3. Let's listen in.
I don't think growth should be sort of the primary focus, right? If we can get growth, great, but I wouldn't be chasing growth as my top priority, right? Because if you look at players like us who are heavily wedded, for example, to the commercial vehicle segment, commercial vehicles for the first 5 months have been virtually a non-event, right? Except for some activity at the lower end, the smaller commercial and light commercial vehicles, the heavies have been virtually a no-show. And our own estimate is that optimistically, you could expect something to happen in Q4, right? And even that, as I say, is optimistic. My own sense is it will probably be FY22 before medium and heavy commercial vehicles see a revival. My own sense, and I've said this before, my own sense is in Q3, we will, when I say we, the industry will see a spike in delinquencies, will see a spike in NPAs. Now, how much it will be, etc., I think, as I said, it's too early to tell. And also keep in mind that the rescheduling, restructuring window has also opened up parallelly, right? So that is in many ways going to camouflage, or it's really going to smoothen over what real NPAs people might have otherwise reported. So it's going to be a tough one to call in terms of what the numbers will look like. But honestly, if people were to tell you the truth, they would tell you that, definitely delinquencies will go up, NPAs will go up.
All right. Well, there you have it. That, of course, is Sundaram Finance speaking on, business outlook and, what sort of delinquencies as well can one expect in the industry. Okay, well, meantime, the stock that has been hogging the limelight, I won't say since yesterday or last week, but I think all of 2020 and throughout this period of the pandemic and the lockdown, is Reliance Industries. It became the first ever Indian company to hit the $200 billion mark in terms of market capitalization. And you know, one of the key triggers why the share price got such a big boost is that there was a report that RIL is planning to sell around a 15% stake in its retail business, and that is something that has propped up the stock price. In fact, not just that, we also do have, the whole story around how Reliance is perhaps looking to do to retail what it did to Jio, sort of sell stake in retail, and I guess that is something now that's sort of perhaps going to drive another leg of rally for this behemoth. That's Reliance Industries for you. Okay, moving on, Varun, Morgan Stanley has a view on financials, in fact quite an optimistic one on some of the biggest private sector banks. What exactly are they saying?
Right, Mabina. So it pretty much was an advertisement rather for the private banks, if you want to call it that. There was nothing negative in this note, beginning with the fact that they say they're really cheap, so 10 to 40% discount depending on which private bank you look at. Obviously HDFC and Kotak have fallen the least, but if you want to go to Axis, ICICI, IndusInd, RBL, you're getting 40% discount to what it was 6 months ago. So they like that. The next thing is that all the private banks, as you know, have raised money, well over $5 billion across all of them. So given that the bear case NPL estimates are just around 2% for some of the banks like HDFC and slightly higher for the others, based on the current capital which they've just raised, even if the NPAs are 2 to 3x of that, they'll still be okay, according to Morgan Stanley. So they like that as well. Then thirdly, the worst is being priced in terms of banks have been very conservative on provision. So they've provided, very extensively. So if the situation indeed doesn't pan out to be as bad as people think, there might be a bit of write back or some improvement there. Provision, they like that the provisions have already been taken in an accelerated way. Then based on the fact that the PSU banks have much weaker balance sheets and they have much more trouble raising money, Morgan Stanley thinks that the future credit growth in India, majority is market share is going to be taken away by the private banks. So according to them, by FY22, which is just next year, not far away, private banks will be back to growing at 15 to 18%. Which is what we saw maybe 5-10 years ago. So that's what they think that can happen in the near term. They've initiated coverage on IndusInd with the target price of 710, and they've upgraded a whole host of the other private bank targets which they have. So according to them, it's an inflection point for the private banks.
All right, thanks Varun for that. So ICICI Bank, Axis Bank, HDFC Bank, all of these are something where Morgan Stanley
Okay, and switching gears a little bit, in our Chartbusters segment, we spoke to top market experts, Dr. C.K. Narayan and Kunal Bothra, and tried to understand the hot picks of the day. They also charted out some smart stocks to power your trades. Here's a slice of that conversation.
In today's price action, IT stocks are doing well, and that's exactly what I'm indicating with the chart here. The chart is a relative performance chart between the IT index and the main Nifty. Now the line in black is the IT index, and the bar chart in blue that I've shown is the Nifty. So we can see to the left side of the chart, that is prior to the big decline, that the IT index was underperforming the Nifty, and the Nifty itself was considerably outperforming the IT index as a whole. But during the big fall, as we can see in the chart, both of them caught up and both of them fared similarly with strong declines. Now the interesting portion comes during the rally that we have been witnessing from the March lows. So the initial portion, as we can see, both the Nifty as well as the IT index are moving in unison, and this was the case for about 2 to 3 months post that bottom, But somewhere around the July or the later part of July, IT stocks began to pick up trends very, very forcibly. And that is manifested now on the chart as the black line, which is representing the CNX IT, that has clearly climbed over the Nifty performance line and is now placed comfortably above it, even as on date. So it clearly shows that the market today is favoring the IT stocks, and this might have happened after the the first quarter results for Infi, for TCS, for HCL Tech. All of them came out reasonably well. People were expecting the worst, but that was not the case. So there was a sudden interest back into IT stocks, and that is what is getting reflected into the IT index, as it were. Now, where do we go with this? The fact is that if the market continues to perform, I think certain investments and even trades to be taken in IT set of counters, particularly the leaders, might prove to be quite rewarding. Infi looks very attractive on its chart, so does TCS, but Infi looks even better. HCL Tech is on the verge of staging a nice big breakout from the top side, so that is something to look out. Mindtree has always been doing well, and recently Mindtree is also about to stage an upside breakout. Only Tech Mahindra lags it a bit, but otherwise I think these 3-4 stock, Coforge is the other one, formerly NIT Tech. So I think all leaders doing well. We would also do well to pay attention to IT major stocks from an aspect of trading as well as for investing.
Okay, fair enough. In just a bit, let's bring on board Kunal Bothra as well. And Kunal, let's talk about the trends that we've seen on the charts for the dollar index and what your analysis is basis the recent move.
So yes, good morning, Avan. I think a very, very interesting set of analysis on the dollar index. Now, on one hand, we have seen how the metal stocks and metal index has rallied. But I think the major reason for that is the weakness in dollar index. So if you can see on the charts, the upper grid is the RSI strength, or the strength of the RSI for the dollar index, and the lower grid is where you see the price patterns for dollar index. Now, just look at the last 5-6 months of price patterns. From 104, 105 levels, the dollar index has gone through a downward spiral. But in the last 1 week, there has been some weakness in the metal stocks. Now, the reason for the weakness is, as you can see on the charts, is the bullish divergence on the dollar index time frame. So the upper grid is showing you a pattern of higher highs and higher lows, and the lower grid, which is the prices, is showing you a pattern of lower highs and lower lows. Now, these are classical signs of divergences. When you see such kind of a divergences, it results into a short-term rally into the asset class. So I'm expecting that the dollar index could probably rally and come back to 95 and a half kind of levels before it goes through one more round for a sharp sell-off. So I think the weakness in the metal stocks could probably persist for the next, I would say, 1 week odd. But I think as a short-term or as a positional trader, take that as an opportunity to buy. I think the stocks like Jindal Steel, Tata Steel, etc., many of these stocks are now indicating that they are heading towards a strong multi-month and multi-year upside move. So looking at the dollar index chart and then trying to extrapolate this to metal index particularly, I believe that dollar index, the short-term rally could happen, but then the eventual weakness could continue, and that should be a good opportunity to buy metal names.
Okay, so that was some chart busters for you. Let's also just take a look at what's happening with the auto stocks, because there's been a lot of good news flow coming in over there. The auto index today is up around 0.33%. Let's look at some select stocks in there. For example, two-wheelers. Let's see how TVS is doing. It's holding its ground. It's up 1% today. Not bad. How's the Hero Motor doing? Let's take a look at that as well. The Hero Motor today is also up around 1.44%. There's been a lot of positive news flow coming in for auto companies in general. What's happened is earlier there was a clear distinction. We were only seeing really good numbers for tractors and perhaps vehicles that were more rural linked. Now that commentary seems to be changing, and on the back of that, we have a whole other bunch of stocks that are also in focus. So just keep an eye out for that. We also had Vinny earlier this morning who was talking to us about a select bit of auto stocks. So that's something you want to keep on your radar and perhaps look at some positions in there as well. But switching gears a little bit and coming to something that was covered on TMS. August saw a second straight month of MF investors redeeming more than they are investing via SIPs or lump sums. On the Money Show, Mubina Kapasi caught up with PV Subramaniam of Subramani.com, who said that a bout of redemptions may be due to job losses. However, he strictly advises all against treating mutual funds as an asset that should be used to book profits for when the market rallies. Listen into an excerpt of this conversation.
Yeah, all these things are happening. One is, when a 53-year-old pilot loses his job, he's not sure whether he'll get it back. So, right, so maybe his retirement has already happened at 53 instead of 60. So some withdrawal will happen for him to meet his household expenses, and his ability to invest money is also reduced because he cannot put in money because he doesn't have a salary. Now that is true for very many people.
What would be the pecking order according to you, Mr. Subramaniam, if I actually have to go in and, sort of liquidate my savings, assets, you mentioned Provident Fund, mutual funds, of course, we are seeing that phenomena. But of all my assets, I mean, is there a pecking order? Because if I look at Provident Fund, I think that, look, this is my nest egg. And then if I'm looking at mutual funds, I feel that, oh, but I have to also invest in the long term. So how should one essentially sort of starve off this period of lull where, I'm jobless, but I still, of course, need to feed myself and my family?
So the most difficult thing to ever liquidate would be real estate, because you'll not be able to sell real estate during such a situation. So selling real estate is out. If you have old endowment policies of LIC, of even of a private sector companies which are now 20 years old, that would be the best, because there you're anyway going to get only 6 or 7% return at best. So best is to redeem that or take a loan against that you may be able to get at 8 or 9%. That would be the pecking order. But what happens is the easiest to withdraw is the mutual fund. At a click of a button, all those things which were told to people, isme kabhi bhi aa sakte ho, kabhi bhi ja sakte ho, no entry load, no exit load. So people are listening to all that and now they're implementing. They're saying, oh, I need money here, at a click of a button, I can get it from a mutual fund. The easiest money to redeem is, of course, the mutual fund. So people are redeeming more from mutual fund than from insurance company. Provident fund, perhaps those people have already redeemed their mutual fund and therefore they're withdrawing from their provident fund. So these would be the reason. There's nothing. If you have equity shares, if your shares, largely people sell whatever is doing well. So if they bought a share at 10 rupees, which is now at 20 rupees, they would sell that. But they bought another share at 10 rupees, which is at 8 rupees, they will not sell that. So like what Peter Lynch says, watering the weeds and plucking the flowers, people will do. They will sell their best shares and they will keep their badly performing shares.
Do you think that a mutual fund is the instrument devised for the kind of activity that we are witnessing? Let's assume that, somebody does have their job and they don't really need the money. But many a times people are also looking at it like we had Mr. Sunil Subramaniam, the MD of Sundaram Mutual Fund, saying that what we are observing is that many people are looking at the market and thinking, let me take some money off. But Mr. Subramaniam explained why, a mutual fund is not the correct instrument, to do something like this, where you can just take some money off because the market is up.
Yeah, it's very expensive because if you get out within 1 year, you pay an exit load and you pay 20% income tax if you make profit. If you're making losses, there's no point in getting out. However, like I said, people will do this watering the weeds and plucking the flowers. So they've invested in a mid-cap, large cap and a small cap fund. They find that they're making money in the large cap fund. They will remove the large cap money and they will keep the small cap money. And wherever they're making profits, some of the profits they will book and they will say, okay, mera itna loss kam ho gaya. Let us say they're 10 rupees, they've invested, the NAV has become 20 rupees and from 20 it becomes 19, they will say, oh, I've lost 1 rupee. So next day they will go and redeem. So people redeem because they are making money. So any fund which is making money for them and they are in the plus, they will very likely redeem and say, I will wait. And there are other people who redeem and say, you know what I did, Subra? I removed all the money from my equity funds and repaid my housing loan. Now this is such a rotten thing to do. But yes, people do this, especially when they're uncertain about their jobs.
Mr. Subramaniam, why do you think that that's not the best thing to do when someone sort of redeems all their mutual funds to pay off their loans? I mean, I'm sure this is a thought that may have come to a lot of people's minds. So why are you against it?
No, I'm not against it. I'm saying if your job is there, you have a good job, it is paying you well. Based on that, you took a 20-year loan. Based on that, you also said, I will do an SIP of so and so and so,
Yeah.
and therefore I will make sure that my retirement plan gets filled up. Now suddenly you change because you see the ticker moving, right? So don't get moved by the ticker. See what you want over the long run. Mubina, what I say today can look very smart. Ye hona chahiye tha. What I am telling you is, if you had invested, if you had removed money in the month of January and you had repaid your loan, you would look very smart today because the market has come down. However, if you do it now, 6 months later, you could look like a complete idiot if the market recovers. Because if you see interest rates now, this is perhaps the best time to be borrowing, because the interest rate for a housing loan is at 7.30. When have you seen it? I'm sure you have not seen it. You must have been in school when it happened at 7.30. It was real long back. So this is not the time to be repaying your home loan. This is the time to be staying steady with your asset allocation. If anything, sit with your financial advisor and decide what to do. Don't react in panic.
All right, well, don't forget to stay tuned to ET Now. Today at 5 p.m. on The Money Show, we have a very interesting episode planned. It's Friday evening, so it will be our ladies' club, or kitty party as we like to call it. Okay, well, it's time then to reveal the answer of our BNSN quiz question. And if you guys have been watching ET Now the last couple of days, then this question should have been a cakewalk for you. So the question that we asked you all via Twitter was, which of the following logistics player has the highest revenue CAGR over the last 5 years? Revenue CAGR. Now the options we gave you were Aegis Logistics, All Cargo, VRL, or Mahindra Logistics. Now remember, my colleague Varun Hiremat as well had done a what's the story on this particular stock. So that's the reason why I said that if you guys had been paying attention to ET Now, you would be the Twitter champion of the day. And guess it was a tough question regardless, because only one person got it right, and that's Chetel Kenny. So by the way, the right answer is Aegis Logistics, which has managed a CAGR in terms of revenue of 12.91%, while Mahindra Logistics comes a very close second with a revenue CAGR of 12.45%. So congratulations, Chetil, for being our BNSN quiz champion of the day. All right, well, on that note, we will take a very short break right here on Buy Now, Sell Now. Don't go anywhere. Hi everyone and welcome back. You're watching Buy Now, Sell Now on ET Now. Well, this week on our Get Rich Mantra, we had the who's who of the global investing industry explain the formula on how to get rich and multiply your wealth. So Mark Mobius as well as Mark Farber share the basics of how to get rich. Listen in.
I would ask them, do you like what you're doing now? Do you love what your work is? And if the answer is no, first thing I would tell them is change your profession. Because unless you love what you're doing, it'll be very difficult to become rich. Once you find a vocation, avocation where you're really very happy, chances are you will do very well and you'll become rich.
And if somebody is rich and wants to remain rich at a time when interest rates are zero by central banks, how can one remain rich or protect their purchasing power?
Again, it's getting hard assets, getting assets, and that means stocks, companies that have assets and have assets that are earning and adjusting to the inflation and to the devaluation of the currency. So that is the only way to remain rich. By the way, that's the reason why many of the big foundations, family offices, etc., come to us and to other fund managers looking for investments in stocks. Now, of course, some people also are in bonds, but I look at bonds as sort of a short-term palliative. The best investment are stocks. And of course, particularly now, with bond rates being so low, you're better off with stocks.
Well, I think if you really want to be rich, you have to work a lot, whatever that may be. Number two, instead of posting your picture on Facebook 3 times a day, I would go and learn something and study. Whether that study includes getting skills at being a good carpenter, electrician, or plumber. These are scarcity jobs in advanced societies, and these are very highly paid jobs if the person has the necessary skills. So whatever you do, you need to have high level of skills. If you are an economist, you have to be a good economist. If you are a computer technician, you have to be a good one. And I think you just raised an interesting question. If you want to be rich, I can tell you, if you want to be rich, money printing by the Fed and by the Reserve Bank of India isn't going to help you. That I guarantee you. The only thing that can help you is, as I said, hard and focused, disciplined work, consistent work, and consistent improvement in your knowledge and skills. That will make you maybe rich, not sure, but it gives you at least a better chance to be rich.
Okay, well, on that note, we'll wrap it up on this episode of Buy Now, Sell Now. Thanks for watching. Stay tuned to ET Now.